Okay, welcome back to Chapter 5. We are on the second example, or Year 6, the second part of the first example, and we are on page 7. So, in Year 6, well, we finished off, let me just summarize. We finished off example 5. We did, not 5, we did Year 5. We did all the steps except for the basic transactions and unrealized realized profit schedule, which we'll do in Chapter 6. We went through all these steps for Year 5. Now we're going to do Year 6. And I want you to imagine we haven't done Year 5. So the only information you have is the stuff on page 2. Okay, so imagine that's all the information you have for acquisition date, and then we'll jump right to so for Year 6, look at page 2. Calculate, what's the first step always? Goodwill and AD. Then continue on page 8. So Company S, net income of 10,000, paid a cash dividend of 3,000. P's net income was this much, an impairment test. Goodwill had a recoverable amount of 3870. Tell me something. Is that what was impaired or what's left? Recoverable amount means what's left. Okay, and that's the end of Year 6. So imagine you did the acquisition differential and goodwill calculation. And actually, if you want to put it on pause and do it again, just so you've practiced doing it, that's great. The next step after that is on page 8. And it's a schedule of changes in acquisition differential. And I've already put Year 5. We've done that already. If we were just doing Year 6, you would have to fill this all out, then fill in the rest. Okay? But I did it just to save a little time. So, we've got inventory from Year 5. Inventory, we go FIFO, so it's sold, so we cancel it out. So Year 6, you do with it, and same with the end of Year 6. And again, remember, this is for the income statement. This is for the balance sheet. So the patent changes in Year 5. We're amortizing it over an 8-year life. So it's $1,500 again. And then we've got $9,000 left. And then the goodwill, it was impaired by 50, so we had $39.50. Now, what did the question on the last page say? The recoverable value was $38.70. So the difference in here, you have to fill in the blank, is 80. Now, because we need to know if we have to decrease net income, of course, net income, there's no effect there. I'm going to go down and go down. And our total is $15.80. And here, our total is $12,870. So this stuff goes on the income statement, this stuff goes on the balance sheet. Now, let's say we were doing Year 10, okay? just to make it easier for you, we start with acquisition. Then we put years 5, 6, 7, 8, and 9 all added together in one. Then we'd want year 10, balance end of year 9. We separate out year 10 because that's the one you want to do. And then we'd have balance end year 10. So, I mean, you're welcome to break this into 5 columns, but generally what you want to do is you want to start with acquisition, do all the changes up to the year before we're working on. Then do a balance here, the year we're working on, and then the end of the year balance. Okay? So, basically, isolate the year we're okay? So, we had only 1 year previously. A lot of the questions in the text will be like, but it was acquired in year 5. So how do you do it? That's how. Okay. So, here's the statements, but we're going to do our calculations. So remember, do this. We have a calculation for the income statement, calculation of net income, calculation of retained earnings, either beginning or ending. And since we pretended we didn't do year 5, we'll need a beginning retained earnings calculation. Okay? But we'll do that on the next page. Okay, so let's go to the next page and do our calculations, and we'll come back and do that after. Okay, so consolidated net income, which is step 5, is for the year. So not a balance. So what do we start with? Actually, you guys, put this on pause and try it yourself. If you have to look at your notes from year 5, that's okay. But just, you've got to start doing some of these so that they get really straightforward in your head. So, put it on pause, give it a try. Remember, you start with your parents, you have the sub, then you add them up together. So we're going to start with parents. So put it on pause, come back, and we'll keep going. So the parents' stated net income for year 6 is on page 8, and it's $21,400. Don't forget to take dividends from the sub. As we saw last time, they only have one investment, so it's $2,400. So that's $19,000, and that's the parents' revised income. Then you take the subs' net income, which is also on page 8, so that's $10,000. Plus or minus changes in 80 for year 6. So that's page 8, which is $1,580. And we're subtracting it because we're trying to make net income go down. We're increasing impairment, increasing amortization. So that works out to $84.20. And by the way, if this goes negative because they started with a loss or something, totally fine. Don't panic. And that's consolidated net income. So I hope you got that right, you guys, and that it paid off. Now, what's the last thing you did? You had to divide it up. So attributable to parent and NCI, and you have to divide first. So NCI gets the portion of which number? They don't own the parent. They own part of the sub. So we're going to take 20% times 84.20 equals 1684. which means the parent gets whatever's left over, 27,420 minus 1684 equals 2536. So this is NCI on the income statement, because remember we've got NCI at acquisition, NCI on the income statement, NCI on the balance sheet. Okay, how did you do? Did you get it right? Biggest mistake that students on exams is they try and take 20% of the whole thing. That's why I keep drawing that little line. Okay, the other thing is the changes in AD only belong to the sub, because that stuff we're adjusting wasn't on our books. It's adjusting the subs books. Okay? So that's calculating consolidated net income. So we need the beginning balance for year 6 because we are doing the statement of retained earnings. And I'll tell you on an exam which one I want, so don't panic. Okay, now, the one thing you have to remember, retained earnings is cumulative. So we're looking for balances or cumulative amounts. Okay, so we'll leave a little column over here because I'm going to show you how to do ending. I'm going to give you the numbers for ending. Okay, we start with the parent's retained earnings. At the beginning of year 6, so it's January 1st. So we didn't have to do this calculation last because it was the first year of acquisition, right after acquisition. So therefore you just start with the parent's retained earnings because sub hasn't earned anything yet. So this is a little bit different. So we start with the parent earnings balance, and that is on page 8, and it is 99,300. That's page 8. Now, again, we're going to add the subs. But remember, this parent's retained earnings balance goes all the way to year 0 when we first started our company. So if I added the subs retained earning balance all the way to year 0, can I do that? Well, when did we buy them? Beginning of year 5. So years 0 to 1, 1 to 2, 1 all the way to end of 4, we aren't entitled to any of that because we didn't own them then. So we can't add that. So what we're going to do here is we're going to add the increase or decrease. Oh, my pen's running out. In the subs retained earnings since acquisition. Sorry, I'm just going to make my pen work. Okay, so the way we're going to do that is to take the subs retained earnings now, so January 1st, year 6, which is 10,800 on page 8. So look at page 8, make you find that. Now, that goes all the way back to year 0. So we have to take away the subs retained earnings at acquisition. So look on page 2, and it'll tell you it was 6,000. So increase in subs retained earnings since acquisition is 4,800. Okay? So, that's good. So that's the parents part, the subs part. And right now we don't have, and not till chapter 6 do we have to do anything with the parent. So, now again, very similar, we're going to add the changes in AD, plus or minus. Except, we need cumulative changes in AD to the beginning of year 6. Okay, so we need everything that's changed with the acquisition differential. We acquired it to year 6, the beginning of year 6. So I'm looking at page 8. Here's our changes in acquisition differential. I need the cumulative changes since we bought it. So this is a balance. What I'm trying to do is look at these income statements and adjust retained earnings for them. Because where did we get this subs retained earnings from? Their books, right? On page 8, we pulled it off their books. Well, does the sub have any of this here? I didn't put that on our books. We put this, remember, this all goes in consolidation land. So the sub doesn't have any of this. So its retained earnings won't be adjusted for that, or because the income statement wasn't. So, where are we sitting right now? Are we sitting at the beginning, the end of year 5, the end of year 6? Where are we? We're at the beginning of year 6, right? So we need all the changes up to this line. Well, we only have one set of changes. Only change to beginning of year 6. Now, oh, and sorry, that should have a negative sign around it, you guys. A typo that I thought I caught already. Okay, so we're going to put the 3550, just the change here, not this, because we're not there yet. We're at the beginning of year 6. So we're going to put the 3550, which was on page 8. Now, are we going to increase retained earnings or decrease it? Remember, net income gets closed to retained earnings. This was an adjustment from year 5 that got closed into there. Are we trying to make the net income go up or down for year 5? Down, because it's impairment and amortization, and cost of goods sold got bigger. So it's going to be subtracted. Don't forget to show these subtracted. Connect warns you have to show the negative as negative. So then it's an indication that it's subtracted. Okay, so we subtract to get 1250, and again, if you go negative, doesn't matter. Okay? So, now, do we deserve a change? No. So we're going to take P's percentage, percent, and that works out to 1,000. And then we're going to take this plus this, unless it's negative, and we get 100,300. And that's called consolidated retained earnings at the beginning of year 6. Okay, so it's a little different than the calculation for income, but it's still parent sub. We just have to sit around to get rid of the portion that we didn't own. So years 3, 2, 1. So we take the cumulative changes, make sure you know if you're beginning or ending, and then you just take a percent of that. I should put a little times there. And that's how you calculate retained earnings. Now, it's the exact same type of calculation to do ending retained earnings, so I'm just going to show you here. Take a sec though, if you haven't got through this yet, take a sec, maybe stop, try doing it, and then come back to do the ending. Okay, so all you do is instead of taking January 1st, you take December 31st. So you're dealing with ending balances. So the ending balance of the parents' retained earnings. It's 112,700. Again, just page 8. Now what's ending balance? 17,800.